Good day everyone and welcome to our presentation. We are from class 3J and it is our pleasure to present this topic to you today. Our team comprises 4 members, Mia Wajiha, Nur Shazani, Nina Shahira, and Nur Shazmira. In this presentation, we aim to provide a clear understanding of the following topics: an introduction to clubs, tax rate, tax treatments, exemptions, and finally, the accessibility of receipt for clubs. We have prepared this presentation to ensure a structured and comprehensive discussion of these key areas. We hope you find the information insightful and relevant. Let us now proceed with the first topic, which is introduction.
Hello everyone, today I'm going to talk about clubs and societies, their purpose, legal framework, and how they are treated for tax purposes. I will explain a little bit about introduction, which include what is club and societies. So, firstly, club and societies are established to cater to a wide variety of interests and pursuits such as social, recreational, sports, art, science, literature, and other leisure activities. They serve as a platform for members to come together and share common interests for mutual benefits. Interestingly, the terms club and societies are not explicitly defined under the Act. However, legal cases and interpretation provide clarity. For example, in Colon Stock cases, a club was described as an association formed for purposes other than business. Importantly, club must not exist to provide financial advantages to their members, except where it's incidental to their main purpose. Another case, Fletcher v. Income Tax Commissioner 1972, elaborated on this definition. The Privy Council recognized clubs as voluntary associations where members come together under a committee to maintain facilities for mutual benefit with no profit motive. Members fund the club by contributing amounts sufficient to cover the expenses. To operate legally, a club must be registered under the Societies Act 1966. From a tax perspective, the IRB has issued Public Ruling 2015, effective from 12 January 2015, which governs the tax treatment of club, association, and similar institutions.
Next, I will explain about the tax rate in clubs. The taxable income of a club is taxed at scale rates that are applicable to individuals, as in paragraph 1, part 1, schedule 1 of ICA. Clubs and associations are not eligible for individual personal relief.
Next, I will be explaining the tax treatment of a club. This includes understanding how income from members and non-members is treated, the principle of mutuality, and investment income. A club is normally set up to service its members, and such may rely on the principle of mutuality for the tax exemption. Thus, members means persons who are entitled to vote at a general meeting of a club. Prior to the year of assessment 2009, there was no specific provision on the tax treatment of a club. But with effect from the year of assessment 2009, Section 53A of the ITA was introduced to enhance the transparency in the tax treatment of a club. This provision applies to a club which is established, controlled, and conducted by its members, not for the purpose of seeking profit. Let's begin with the principle of mutuality, which is the foundation of tax treatment for the club. The principle states that a man cannot make a profit by trading with himself. In simple terms, when a club collects funds or contributions from its members and uses them for the club purpose are exempt from tax. Any surplus from those funds is not considered as income. This is because the contributors are essentially participating in the surplus. Mutuality only applies to transactions with members, not non-members. Therefore, when the trade is made within non-members, the principle of mutuality no longer applies and any surplus arise is subject to tax.
I will move on to the next part, which is exemption for clubs. Let's begin with the principle of mutuality. This principle is central to the tax exemption available to clubs. It essentially means that a club cannot profit from its own members. As a result, contribution or subscription made by members are not considered taxable income. For example, surplus from membership fees, entrance fees, or other payments for service or goods provided to members are not taxable, whether it's membership fees or access to the clubs or the sale of goods to members. The income remains exempt. This ensures that clubs operating for their members' benefits are not unnecessarily burdened by tax obligation. Next, let's discuss the condition for tax exemption. For a club to maintain its tax-exempt status, it must meet certain criteria. First, operate non-profitably. The club must not function as a profit-making entity. Second, reinvestment of surplus funds. Any surplus generated must be reinvested into the club's activities, ensuring that funds are used to enhance or maintain its objective. The third one is no personal benefit. No part of the income or surplus should personally benefit members, office holder, or individuals. Fourth, proper records. Finally, the club must maintain proper financial record and comply with all reporting requirements to ensure transparency and accountability. Example of income that may qualify for exemption under this condition includes membership subscription from members, which is considered mutual income, fundraising activities aimed at improving club facilities or making charitable contribution. Additionally, income from association, fundraising, event, or certain investment income directly related to the club's objective may also be exempt. Now, let's move on to non-members. When a club engages in transaction with non-members, the mutuality principle no longer applies. Any surplus generated from these activities is treated as taxable income. For example, if a club rent out in facilities to non-members or organize fundraising events involving the general public, the income from this transaction is subject to tax. This distinction is important because clubs often engage in activities that involve non-members, and failure to properly account for this income can result in non-compliance with tax law. Although income from non-members is generally taxable, there are exceptions. To qualify for tax exemption, the following conditions must be met. First, the activities generating the income must align with the club's primary purpose, such as social, recreational, or charitable goals. Second, the income must not result in personal profit for any members or individual. Third, proper documentation must be maintained and approval from tax authorities may be required to support the exemption claim. Some examples of non-members' income that may qualify for exemption includes proceeds from a charity dinner open to the public, where the funds are used for charitable cause, income from public tournament or event that directly benefit the community or the club's objective, sponsorship income that is allocated to the club's activities or facilities. In such cases, the focus is on ensuring that the income is used in a way that aligns with the club's purpose and does not provide undue personal benefit to members or office holders.
Next, let's look at income from members. Under the principle of mutuality, income received from members is not taxable. This includes the first one is entrance fee and subscription. The second one is provision of service to members for a fee. The third one is sales of goods to members. Any expenses or capital allowance attributable to such income shall be disregarded, and any loss incurred also shall be disregarded. Income received from the provision of trading facilities to members is deemed to have a carry on a business will access under Section 4A. Lastly, cash donation received from members is capital receipt and it is not taxable. So, what's about income from non-members? Non-members are defined as people who are not entitled to vote at general meeting. Unlike income from members, any income generated from transaction with non-members is taxable as business income. Business income from non-members include the first one is fundraising activities open to the public, such as selling foods. The second one is renting out club facilities like hall or equipment. The third one is amount paid by non-members to attend dinners, social function or talks. 4. Proceed from the non-members on charitable event. As same to the members, cash donation received from members is capital receipts and this is not taxable. Trading activity below is subject to tax. Restaurant, bar, entertainment, outlet, proceed received from the vending machines. Next, approved donation defined as cash donation to an approved institution or organization are entitled a deduction up to 10% of the aggregate income. G times H divided by I. G. Cash donation under Section 44, Subsection 6. H. Aggregate income from transaction with members. I. Aggregate income from transaction with members plus non-members. Now, let's move to the investment income. Investment income is treated as taxable unless specifically exempted. Investment income such as rental, interest, and dividend is also treated differently. Income from non-members is taxable because the principle of mutuality does not apply to the investment income, as rental and interest will be taxable in the hands of club. It is because the principle of mutuality does not apply. Those dividends are tax exempt under the single-tier dividend system. I think that's all from me. Thank you.
Okay, next. As you guys can see, this is an example of how to calculate tax income for the clubs. As we know, we only calculate the income from non-members only. Okay, first, we take section 4A, which is business income from non-members, and then we deduct with wholly and exclusively expenses, which is the common expenses. To calculate the common expenses, we have to use the formula that my friends have explained before. For this example, the common expenses is salary and wages, administrative charges, postage, stationery, and printing. And then we total all of these expenses and we got 180,000. And then we multiply with income from non-members, which is 120,000. And then we divide with gross income from members and non-members, which is 300,000. After we get the adjusted income, we have to deduct with common capital allowance. To allocate, we use the formula for common capital allowance and we got 50,000 times with 120,000, which is non-members' business income, and divided by 300,000, which is gross income from members and non-members. Next, to get the aggregate income, we have to add to section 40, which is rental income. For the approved donation, we also need to apportion using the formula. And then we get the chargeable income. To calculate the income tax payable, we have to use the scale rate based on the chargeable income. And then we got the income tax payable.